We are officially back in a good news is bad news market, and that jobs report just became your portfolio's biggest problem. So today, we're going to break down why the Federal Reserve is slamming the brakes, analyze Shopify's and AppLovin's earnings disaster, and more importantly, how to position yourself for the massive AI company earnings that's dropping tonight. Now, as we look at the current state of the market, we have entered a phase where positive economic indicators are actually viewed negatively by the market. So this paradox, we call it the Wall Street paradox, it occurs because strong growth suggests that inflation may persist, forcing the Federal Reserve to keep interest rates higher for much longer periods. So let's start with taking a look at the macro because that dictated the flow of the day. Now, the headline story that we saw yesterday before the market opened was the January jobs report that came earlier than expected because of the partial government shutdown. So this was by the Bureau of Labor Statistics, and the consensus was for about 70,000 jobs to be added. And instead, this expectation was blew past, and the US economy actually added 130,000 jobs, which is a good thing, right? And simultaneously, what did we saw the unemployment rate? The unemployment rate unexpectedly dropped to 4.3%, and the consensus was 4.4%. So this is a good news. More jobs are being added to the economy, and unemployment rate is dropping, right? Now, because more people working, this is a celebration. Now, this unexpected surge in hiring has completely changed the narrative regarding the Federal Reserve timeline for monetary policy easing this year. Now, and what we saw was that the market immediately trimmed its bets on both a March and April cut. You can see that back in March, what was the probability just a day before of a rate cut was 20%, and now it has dropped to 6.4%. Whereas in April, a day ago, it was 36%, and now the rate cut has dropped to 21%. So you can see how good employment data has caused the probability of rate cuts to actually drop instead of increase. So there is this growing disconnect right now between Main Street and Wall Street, because while a hot economy is good for workers, right, it is creating a headache for those who are hoping for rate cuts. Because if the economy is doing well, which means more people are getting hired and more people have jobs, there is no reason for the Federal Reserve to cut interest rates. In fact, the reason why interest rate was being cut the past few months was because the labor market was getting hotter, right? There were more people getting unemployed, unemployment rate was increasing, jobs were decreasing. So that's the reason why rate cuts happened the past few months. But now that jobs are being added, more jobs are being added, and unemployment rate is decreasing, there is no reason for the Federal Reserve to do any immediate action. So they are currently keeping the foot on the brake to prevent the economy from overheating. And what we saw, the market's reaction was very swift and decisive, and it was across all asset class. Like we saw the 10-year Treasury yield actually jump to 4.18%, close to that, which immediately puts pressure on risk assets. And these indices also reflect the indecision perfectly across. Even Dow, right? Dow broke its 3-day win streak to actually close the day red. So what we saw was investors actually rotating out of volatile tech and park their cash in more defensive sectors. Crypto actually felt a hit as well, with both Bitcoin dropping to around the 66K range and Ethereum dropped below 2K. Even right now, Ethereum is still below 2K. And we saw a little bit of recovery in Bitcoin, sitting at roughly 67K right now. But it's very clear that the risk appetite has vanished, or it has reduced as compared to a few months before. Now let's go deeper a bit on the earnings that moved the needle yesterday, because the market's reaction were brutal on some of them. The first one was Shopify, right? On paper, right, Shopify had a great quarter. Revenue hit close to 3.7 billion, beating expectations by near 100 million. And their gross merchandise value, so is also known as their GMV, actually surged over 30%. And their president even called the growth remarkable. But as we know, right, what do markets care? Markets do not care about your top line, do not care about your current results. They only care about what you guide ahead, and also whether are you very, very profitable more than just your revenue. So they actually missed on their earnings per share, and worse still, they guided for lower free cash flow margin in their first quarter. And what happened? The stock actually crashed close to 7%. So what do I think over here is that revenue growth is not enough, right? You have to show efficiency in your numbers. So that's for Shopify. And then we have the wilder story of the day, which is AppLovin. So AppLovin had a textbook crush and beat. So revenue was close to $166 billion and it was up 66% year over year. We have insane adjusted EBITDA margin of 84%. So they have their own AI engine. It's called Axon. It's actually printing money. Even their CEO said it was the strongest performance in company's history. Strongest performance. But what happened to the stock? It actually fell 7.5% in after hours trading. So this is a classic buy the rumor, sell the news scenario where the stock has run up so much prior to the report that perfection was already priced in, and any little thing that is not expectations will actually cause the stock to get sold down, which is what we saw. Now, on a more positive note, right, we saw McDonald's, one of the fast food brand that I'm pretty sure every one of us have heard before. McDonald is showing that a focus on value can win over the consumers. So their $5 meals, which is available everywhere around the world, is actually driving traffic, and comparable sales are also up globally. So what does this suggest? It suggests that while consumers are price sensitive, they are still willing to spend on the right value proposition. And especially as when the economy is good, right? Looking at how consumers are spending, what kind of food they are purchasing, is also a good idea to tell you whether are we heading more towards recession territory. Are they becoming a bit more thrifty with their money, or are they being more aggressive? So what this shows is that consumers are moving more towards value products, value food, and cheaper food choices as well. Now, that brings us to today, right? Thursday. And if you thought yesterday was busy with Shopify and AppLovin, today is even more critical for the AI narrative, because this sector has been a primary driver of market gains last year, the whole of 2025. Why, you might ask? Because first, we actually have Applied Materials. So after the closing bell today, all eyes will be on Applied Materials. Now, this is, I would say, the most important chart of the day, because Applied Materials is what we call the pick and shovel play for the semiconductor industry. They make the equipments that makes the chips, the semiconductor chips. And this year alone, the stock is really up close to 25%. Now, revenue estimates is at roughly 6.88 billion, and if they beat these revenue estimates and shows a very strong demand and backlog, what does it confirm? To me, it confirms that the AI infrastructure build-up is still accelerating. And if they miss on this number, it would not only drag down the company, it could drag down the entire semiconductor sector, or even any companies or any businesses that are involved in AI. Now, the next one is also related to AI infrastructure. Nebius, right? So Nebius is a pure play AI infrastructure story that provides the GPU powered cloud capacity that trains and runs AI models. So this stock has been a high beta AI name this year. What does high beta means? It means it is extra volatile. And why? It is because investors are betting and putting their money on accelerating compute demand. So if Nebius delivers strong revenue growth and very strong upbeat guidance, so it will also reinforce the narrative that AI infrastructure spending is still ramping. But if it misses or signals slowing demand, this could pressure the broader AI trade, and that will raise questions about how durable this build-out really is. Now, we are also tracking the health of the digital consumer, and it is through DraftKings and Roku. So DraftKings and Roku will offer us some idea into discretionary spending as well as the digital advertising market. Now, with inflation still remaining sticky, now it's at 2.7%, and in fact this Friday we are going to see how that number changes. So with inflation remaining sticky, we want to see whether consumers are pulling back more on entertainment and gambling expenses. And when we look at other macro news, right, and what we are going to see is a few things around the world, not just the US. The first thing we are going to see is the Federal Reserve Governor, Lisa Cook. She is going to be speaking in Miami, and her speech will be closely monitored for any hawkish clue relating to inflation. Okay, so this is important to monitor because she is a voting member of the Federal Reserve Board as well. And then in Switzerland, right? Switzerland we are also going to get their CPI data. Now for Europe, right? This is a big one. Why? Because if inflation comes in hotter than expected, what we can expect to see is the Swiss National Bank might have to pivot on their monetary policy. And this will also affect the Swiss franc, which is the currency. And finally, we talked about Japan previously, right? We also want to take a look at that because one of the Bank of Japan board member, Naoki Tamura. So Naoki Tamura is a known hawk. And if he starts talking about ending the yield curve control or hiking rates, so what could this lead to? It could lead to an unwinding of the yen carry trade. Now, in summary of what we saw for today is that the market is at this critical pivot point. What we are balancing now is this paradox of very strong economic data, which shows us that the economy is healthy, against a very cautious Federal Reserve about rate cuts. So to navigate this, always stay nimble and always want to keep a close eye on treasury yields, as well as this week we still have the core CPI, so that will actually play another role for us to determine whether the Federal Reserve might actually cut rates in the next few meetings. And always ensure that your portfolio is prepared for continued volatility as we see the earnings season progress. In fact, we're going to have more earnings over the next few weeks, and even Nvidia, their earnings is going to be reported at the end of the month as well. Now, that's all that we have for today's Stock Market Digest. So I'll be back tomorrow to break down exactly what happens with Applied Materials as well as other AI companies, other earnings at the markets. So make sure to hit that like and subscribe button so you don't miss the update. And I'll see you tomorrow.